Welcome, and thank you for joining us today for Gearing Up for 2018 Business Success. Today, Cardinal Services CEO Arin Carmack will be talking about new legislation, updates, and what to do to become compliant. Welcome, Arin.
Great, thank you. Well, another year, more changes. In fact, so many changes, I had to gloss over some of the details. So today we're talking about employment law, recent changes, updates, new laws, and some possible future trends. And in the past, I'd poked fun at the state legislature for creating a sick leave system where you can accrue 80 hours, but only use 40 of it. And our team, and I'm sure you as employers, have really enjoyed explaining this. Yes, I know it says that you have 80 hours of sick leave, but you can only use 40 of it. Well, as of 2018, because of Senate Bill 299, you can now cap sick leave at 40 hours. The law also better defined employees. And this is important because if you have 10 or more employees, it has to be paid leave. And so most owners, most family members are now excluded in employee counts. And of course, the Bureau of Labor and Industry came out with new Oregon administrative rules. So by honorable mention, I mean that I'm going to gloss over some of the details. For example, the Fair Work Week, I could spend my entire time today just talking about this. But it really doesn't apply to 99% of you, and if it does, I suspect you're very aware of it. As a summary, this law requires service employees to be given 2 weeks notice of their upcoming schedule. So if you call them in, the less notice you give them, the more money you have to pay them, which sounds like an administrative nightmare. Same thing with manufacturing overtime. I suspect that if it applies to you, you're already aware of it. These employers, mills, canneries, factories, manufacturing, will have to pay overtime on any work over 10 hours per day, 40 hours per week, or the greater of those two amounts. They also have to do some other things like get waivers from employees that work over 55 hours per week. Of course, there are many other requirements to the law. So Oregon Saves, you're going to have to either offer a retirement plan or use Oregon Saves. And Oregon Saves is essentially a state-sanctioned Roth IRA. They contract with a third-party administrator called Ascension. The employer takes the money out of employees' checks, gives it to the third-party administrator, who deposits it into one of 13 State Street funds. So Oregon Save's plan to get people to save is what I've heard to as libertarian paternalism. So employees have to specifically opt out of contributing with the form. And Oregon Saves is counting on employees being too lazy to do so. So if you remember Cover Oregon, at $200 million on the Obamacare website that didn't work. So I think that Oregon Saves is aware of what happened there and came out with this 3-year rollout. So if there are problems, it's just going to be limited to a handful of employers. And then notice the note on the bottom. They're now saying, if you want, you can always sign up early. No need to wait. Word is that employers are choosing not to participate, and I'll give you my take as to why on the next slide. But as to signing up early, this is probably why Cardinal's legal department made me put on the second slide, not legal or financial advice. So Oregon Saves is specifically designed that you would not be subject to ERISA requirements. That's the federal retirement plan law. But if you offer a benefit early and not legally required to do so under Oregon law, that could make you subject to ERISA. So my take as to why employers are not flocking to Oregon Saves, well, here's a slide from their presentation. It looks real easy, right? 90 days, 60 days, plenty of time. Well, here's how it looks like to your benefits people. And they're looking at it saying, so you want us to sign up a new employee in 30 days, even when they might not work out? That's why we offer benefits at 90 days. And then on top of that, the very last point on here, that you want us to adjust that amount every year for 5 years. And the reason behind this, my understanding, is I met with the executive director of Oregon Saves, and it sounds like the Oregon Savings Board thought if you do the withdrawals at 30 days, hopefully that's early enough that employees are not going to object. And if they do the percentage increase 1% over time, maybe they won't notice. The only thing that they forgot about were the objections of those who actually have to administer benefits. So when you have to comply with Oregon Saves law, you really should compare it to a 401k. Three things stand out: quality of funds, the quality of them, the fees, because these can really add up over a 40-year career, and service. So using Cardinal as an example, you can see how it stacks up. We should dig a little bit deeper. Funds and fees, Oregon State uses State Street funds. They're good quality funds at a low price, and that's just my personal opinion. I even checked to see if they had 12B-1 fees. And according to Morningstar, the ones at State Street for Oregon Saves, they don't, which is a good sign. The 12B-1 fees are those not required to be listed on your fee disclosure. Essentially, they're a rebate to the third-party administrator, which I find to be a questionable practice. I highly recommend that if you have a 401k that you check on these. And personally, I've been with Cardinal for 20 years, been contributing a portion of my income into our plan, so I've got skin in the game from both personally as a CEO, have a legal responsibility to offer a good plan. So this comparison that you can see at this point, while accurate, is just a starting point. There are plenty of good plans out there, and Oregon Saves is better than no 401k at all. My point is that you should shop around before you have to comply with this law. And if you want our compliance guide on choosing a plan, go to savingoregon.com. You can put in your email address and download a copy. So if you co-employ, that means that you and I divide up responsibility for employees. So you supervise, Cardinal cuts the check, pays the taxes on the employees. Who's in a co-employment situation, who's the employer according to Oregon Saves? It's a good question, and we wanted to make this clear. Because if you remember sick leave, law and administrative rules didn't address items like, so you have an employee that earned sick leave at Cardinal and then gets converted onto our customer's payroll. Does that earned sick leave follow because it was essentially the same job, just different employers on paper? Well, it took a couple of years for that actually to get addressed. So Cardinal participated in the Oregon Saves stakeholder meetings and proposed this rule. Whomever the employer of record is, they're the ones responsible for complying with Oregon Saves. It's difficult for them to argue with me because our customers really don't know if we've taken money out of our employees' checks and given it to the third-party administrator. So I said, make us responsible for that. Comparable pay for comparable work. This is pretty non-controversial. In fact, isn't that what we're already supposed to be doing? Problem is that this is not happening. So the state has taken steps to impose a solution. First, the state restricts employers from asking about pay histories. Now, you can still ask the applicant what they need to make or what they expect to make. You just can't ask about their pay history. So employers will need to review employees in similar positions and make sure you're paying all the employees a comparable wage. Now, there are genuine reasons to have different rates of pay as listed in the slide here. For example, you're going to need to pay an employee working in Portland more than one living in the Dells simply because of the cost of living. And of course, make sure you document your reasoning. So here's the timeline for this. Right now, you can no longer ask about pay history. Most everything else goes into effect 2019, and then employees can pursue civil penalties in 2024. So right now, review your application for pay history. Make sure those are taken off. Train your managers, interviewers, not to ask about pay history. We have most of 2018 to ask to review employees for comparable pay. And of course, like I mentioned, document your results. And once that's done, set a reminder to do what's called an equal pay analysis on each group of employees every 3 years. So apparently Oregonians use the earned income tax credit much less than other states. 2013, that was the last year I could find numbers for. Oregonians left $100 million of these tax credits unclaimed. So the legislature decided that employers would have to start giving a form on tax credits to employees. A well-meaning goal. And true, it's just one more piece of paper us employers have to give employees, but that's what the government said about the last dozen forms. At this point, we're still waiting on the forms from the Bureau of Labor and Industries. Once they're released, we'll of course get that in our newsletter. Now, just because the tax rates have changed doesn't mean that these estimated taxes, or what are called the tax tables, are automatically updated into payroll programs that are used to cut checks. The IRS recently released the new tax tables, and then it takes a little bit of time for employers to update the tax tables, and any discrepancies get worked out at tax time next year. As to new W-4 forms, it's unclear whether we'll be needing new ones for existing employees. I've heard contradictory information on this. And if they do, of course, once again, this will make our newsletter. So the individual mandate goes away in 2019, and that's the tax you get if you do not purchase health insurance. That's roughly about $700 or 2.5% of your income, whichever is greater. With this being phased out, I think that pricing for individual plans will continue to increase significantly, specifically here in Oregon. And as I've said in the last couple of years, that small employer plans are continuing to be the bright spot with the Affordable Care Act. In some cases, the price for a small employer plan is much cheaper for the same level of coverage that's offered in the individual market. Quick reminder, minimum wage goes up again in July. You're going to need a new poster. We'll be sending out a newsletter to sign up for those posters. Now, I thought this one was interesting. If the employer requires the employee to sign what they know to be a false document, there can be a fine on the employer. I thought it was just interesting because it's like, let's now make robbing banks more illegal by requiring licensing for bank robbers. So some possible state issues that I foresee: harassment, it's been in all the headlines. California has a mandatory training for supervisors. All but guaranteed Oregon legislators are going to be looking at this in the future. Safe's reserves, they have a pot of money that they save to pay for future claims. It's a rather large one, and it's been a target in the past. With PERS being underfunded, there's renewed talk of raiding this fund. And of course, employers are saying, wait a minute, we've been paying those costs, and that large reserve keeps our workers' comp rates low. So it's going to be a contentious issue. Paid family leave, once again, something that California has, might be imported by our legislators. Now, this is a possible rule from the United States Department of Labor that was withdrawn. With electronic devices, when we're working and when we're not working, it's kind of difficult to tell. So you have email, text on telephones. So if you're answering a dozen email on your phone at night, that certainly sounds like working. But if you're sipping a Jose Cuervo on the beach in Acapulco and reply to a quick text message, probably not. This proposed rule would have created a definition. Like I said, it was not pursued, but I included in there because I think that's something that needs to be addressed in your employee handbook. Thank you for attending this, watching this, legal update. If you have any questions, please contact anybody at Cardinal to get those answered. Thank you.
Thank you, Arin, and thank you everyone for joining us today. Like Arin said, should you have any additional questions or need help with anything, please call us at Cardinal at 800-342-4742.